All right, so good. All right, welcome. If there's any viewers, thank you for joining in. Good morning. I'm Justin Halsey, and I want to thank you for spending some time with me this morning to talk about buying your first home. I am a mortgage loan officer with Edge Home Finance, and I am licensed in Virginia, Florida, Maryland, and North Carolina. I do want to mention that while this information is designed to help you, it hasn't been reviewed by any government agency and not affiliated with any specific agencies we'll be discussing today. If you are here, I would love for you to drop a comment just to say hello. But yeah, let's get started. So before we get rolling, I would love for you to check in for today's class just so I know who is here today. So if you don't mind taking out your camera on your phone, scanning this QR code, and just checking in for me. This way it helps me stay in touch and we can reach out later on. I'll give you a second to do that. All right. So I'm excited about what we're going to cover today because we aren't just talking about houses, we're talking about your future. So here's a roadmap for success. We're going to talk about owning versus renting. We're going to get you ready to buy your first home. The pre-approval process, credit and your finances, affordability, and then the 6 steps to buying a home. So I really want you to understand this first part here because we're talking about the difference between being a tenant and being a stakeholder in your own future. You see, the difference between renting and owning isn't just about whose name is on the deed, it's about whose dream you're funding. When you rent, you're helping your landlord reach their goals. But when you own, you start hitting your own. So let's look at the 4 major advantages on the screen. So 1, it's a wise investment. Owning a home isn't just about having a roof over your head. It's one of the most powerful ways to put your hard-earned money to work for you. Your home appreciates. So historically, homes tend to increase in value over time. That means while you're busy living your life and making memories, your home is busy growing your net worth. Building equity. Every time you make a payment, you aren't just paying a bill, you are building ownership interest. And we call that equity. That is real wealth being stored away for the future. And there are some tax advantages. The interest you pay on your mortgage is typically tax deductible. Now, I'm just a mortgage guy, not your tax person, so be sure to consult with your tax advisor on the specifics behind that. So let's continue. So a few more reasons why taking this step is such a powerful move for the future. Being a homeowner gives you something a rental agreement never will: control and stability. So you have that pride of home ownership. This is your piece of the American dream. You'll have the freedom to make your house truly your own, from painting the walls to landscaping your yard. You also have more control over your monthly payment. When you have a fixed rate mortgage, your principal and interest stay the same for the life of the loan. You don't have to worry about a landlord hiking up your rent every year just because the market changed. And then you're also building your future. Every single payment you make is an investment in yourself, not someone else's retirement fund. So if you're going to pay a mortgage anyway, you're going to pay a mortgage anyway. Sorry about that. You're going to pay a mortgage anyway. The only question is, are you going to pay it to your own or going to fund your landlord? So Zig Ziglar used to say, you were born to win, but to be a winner, you must plan to win, prepare to win, and expect to win. And that's exactly what this slide is all about: putting your winning plan into motion. So getting ready for a dream home is a simple 3-step process. First, we're going to find your home team of experts. You don't have to navigate this alone. You need a championship team in your corner. You need an experienced real estate agent, a knowledgeable mortgage professional, such as myself, and a trusted insurance agent. When you have the right experts, you have the right answers. Then we complete the pre-approval process. This is where I get to work. We'll submit your application, we'll gather your documents, and explore the loan options that fit your specific goals. This gives you the financial green light to shop with confidence. And then we'll consult with your real estate agent. Once you know your numbers, it's time to look at the map. Talk to your agent about what's available and where you want to be. The best time to start moving towards your goal is right now. The bottom line here is you don't have to know every step of the journey to take the first step. So let's get your team together and get you moving towards those keys. So now that we have the set stage, now that we've set the stage, let's get down to the basics of home ownership. This is Home Buying 101. All right. So let's look at the factors that go into your pre-approval. All these items play a huge part in determining how much you can qualify for, and because they are all important, we really need to focus on each one. First off is your credit history, and this shows us how you've handled your financial commitments in the past. Your employment status. We look at your work history to ensure stability moving forward. Income. This is simply the amount of money you have coming in to cover your new mortgage. Existing debts. We take into account any current monthly obligations you already have, like a car note, student loans, installment loans, and then credit card debt. And then down payment. The amount of cash you're planning to put towards a purchase can change your loan options. Remember, there are programs out there that allow for low or even zero down payments, so don't let that part intimidate you. My job is to look at all these pieces together to find the best fit for your situation. One of the biggest questions people have is about the first point on the list, so let's talk about that a little bit more, about your credit history. So what determines your credit scores? The main four factors are new credit and types of credit, and that makes up about 20% of the score. The length of the credit history, so about 15% of the score. The two biggest ones are how much you owe, and that's 30%, and then the payment history, 35%. So the key to achieving a good credit score is how much you have on credit and what your payment history on those debts are. Are you maxed on your credit cards or other loans, and do you pay your bills on time? So your FICO score, as it's called, is an indicator of how you manage debt. If you have a history of making payments on time, it's a good indication that you'll make your mortgage payments on time. Your credit score can impact your interest rate, how much a lender requires for down payment, and the amount you can borrow. The good news is you do not need an 800 FICO or 20% down to purchase a home. Oh, that's cut off a little bit. I apologize for the bottom being cut off. So how much do you need for a down payment? That depends. Today, there are loan programs with flexible down payment options, including low or no payment options. No down payment options, sorry. Some home buyers may be eligible for down payment assistance, and of course, the amount you put down will in fact impact your mortgage payment. That's why a consultation with a mortgage professional is the first step towards becoming a homeowner. So how much can you afford to buy? One criteria used in qualifying for a home loan is your debt to income ratio, also known as DTI. Your debt to income ratio is typically the anticipated total housing payment plus your existing debt payments divided by your gross income. Your loan officer will review your debt to income during your initial consultation and review which loan programs you qualify for. The key is get pre-approved so you know exactly how much house you can afford. So what is included in your mortgage payment? Your mortgage payment is determined by four things often referred to as PITI, or principal. The principal payment, your interest payment. So principal and interest is what your mortgage payment is, and then your taxes, your property taxes, and your homeowner's insurance all make up your principal, interest, taxes, insurance, or PITI. That's your mortgage payment. So just to note, if you put less than 20% down, you may be required to have mortgage insurance. Double check with your mortgage professional. So home buying 101. Which loan type is right for you? So there's conventional. We're talking about loans. Sorry. Let me start over. I apologize. When talking about loans, the first step you can take is to learn the two basic classifications of home loans. There's conventional and then there's government-backed loans. Each loan type has its advantages and disadvantages for the borrower. So let's take a moment and explain the main differences. Conventional loans are standard non-government mortgages. Conventional loans are not guaranteed by or insured by a government agency such as Federal Housing Administration or FHA, the Department of Veteran Affairs, better known as VA, or Department of Agriculture, USDA. Conventional loans are also known as conforming loans because they conform to the rules set forth by Fannie Mae and Freddie Mac. Conventional loans are backed or insured by Fannie Mae and Freddie Mac, the two largest investors of conventional loans, and they have specific loan underwriting criteria. They have invested in nearly half of all U.S. home loans, so they're important to homeowners and potential buyers alike. Conventional loans typically have a lower debt-to-income ratio and higher credit score requirements. Lower credit scores impact interest rates, and if you're putting less than 20% down, you'll need mortgage insurance, which tends to carry a higher cost as compared to government-backed loans with less than 20% down. The types of conventional loans includes conforming, and conforming is a term we use to describe the loan limits set forth by Fannie and Freddie Mac. For most of the U.S., the conforming loan limits are at a maximum of $832,750, and in some areas of the country are considered high-cost areas, such as California, Hawaii, and New York, and the conforming loan ceiling is, in most high-cost areas, is $1,249,125. So non-conforming loans are loans that are not backed by Fannie Mae or Freddie Mac or exceed the conforming loan limits. Jumbo loans are the type of non-conforming loan because they exceed the conforming loan limits. Fixed rate loans are the most common choice. The interest rates stay the same for as long as you have the mortgage. Many buyers choose a 30-year fixed rate loan because it usually results in an affordable monthly payment, but shorter terms are also available. Adjustable rate loans have rates that may go up or down over time. The adjustable rates usually adjust annually after an initial fixed period of typically 3, 5, 7, or 10 years. So the main benefit to conventional loans, if you can meet the underwriting guidelines, is lower total loan costs compared to government-backed loans. So government-backed loans are insured by the U.S. government or local state agencies. When we talk about government-backed loans, we're typically referring to FHA loans, VA loans, and USDA loans. Government-backed loans include FHA, USDA, state and local bond programs, or better known as down payment assistance programs. And bond programs are used by city and local governments to help fund down payments and lower closing costs of buying a home for community members who otherwise might not be able to afford it. These type of loans offer more flexible qualification guidelines. VA loans are backed by the Department of Veteran Affairs. They generally do not require a down payment or mortgage insurance, but veterans and active duty personnel who secure a VA loan do need to certify they intend to personally occupy the property as a primary residence. So which type of loan is right for you? The loan programs we discussed today offer a range of finance and down payment options. Interest rate is only one component to obtain the ideal mortgage for your situation. And by working with an experienced mortgage professional, you can select the loan that best suits your budget and goals. So now that we have an understanding of the loan programs available, let's take a look at the home buying process. There are 6 main steps to the home buying process. Step 1, you complete the loan application. You provide the income and asset documentation to your mortgage loan officer. You get pre-approval letter and share it with your real estate agent, and then let them know you're ready to go. Then you review your pre-approval with your realtor and discuss your purchase options. You guys formulate a plan to see the homes that fit your budget and needs, and then you start shopping. Stay focused and don't get discouraged, and always stay in contact with your realtor and lender, and don't engage in any large spending or obtain credit during this time. Now that you've found your home, you work with your realtor to make an offer. You review the offer with your lender and update your pre-approval letter if needed, and then you submit your offer to the sellers. If they accept it, then we submit the application, we order the appraisal and property inspection, we submit updated documentation as requested by the lender, acquire homeowners insurance, and then the final step is you receive final loan approval from the lender, you review your closing disclosure, you coordinate with lender and realtor to sign the final documents, and then you get your keys to your home. Excuse me. So to recap, you're ready to buy your home. So you're now an educated consumer. Let's review the key points and get with your mortgage consultant professional for more details that we discussed. So we discussed the benefits of owning versus renting, the importance of getting pre-approved, understanding your credit and FICO score, and then we covered down payment options, which may vary based on your situation. And then we went over how much you can afford, the basic understanding of conventional versus government-backed loans, what makes up your mortgage payments, such as your principal, interest, tax, and insurance, and knowing the 6 steps to the home buying process. So the class is over, but you've only just begun your journey. I am here to help you and guide you if you have any questions along the way. I'd be happy to talk. You can scan this QR code and it goes directly to my schedule, so you can schedule a consultation with me. Again, thank you for watching. I'll be on for just a little bit. If there's anybody still here and you want to ask a question, you're more than welcome to do so. Again, thanks for joining.